I truly hate this debate. It's bad news, good news. Live from New York City this morning. Good morning, good morning. A second straight negative quarter in America. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Live from New York City, we begin with the big issue. It's all about the data.
The data?
Data.
We've got a lot of data.
Jobs data, wage data.
A lot of data coming up.
Chair Powell talked about this.
What Chair Powell told us is, well, he's data dependent.
The Fed is going to look at many things.
We've got a GDP report.
Today's GDP.
Of course, the GDP number is going to be very important.
The Michigan survey.
We'll get payroll. We'll get the employment cost index.
ECI is very, very important.
The employment cost index.
This concept of a wage price spiral.
Watching the economic data.
It's super, super important.
The Fed, while not getting rid of forward guidance, they're data dependent.
So very data dependent now.
Dependent on what data? This one. The economy shrinks for a second straight quarter. Joining us now, SocGen Subhadra Rajappa, Jim Bianco of Bianco Research. Subhadra, let's start with you. Your response to that data 30 minutes ago.
It was a surprise. I think most people were expecting at least a modest sort of a positive print. Negative, close to negative 1% print is definitely something that, you know, catches your eye. And you also have the fact that you have 2 quarters of negative growth. Yes, it's not a recession, doesn't feel like a recession, but it's certainly going to grab our attention. But this, you know, the price action in the bond market today is really what data dependence is all about, where you get a weak print and the market almost immediately reacts to the weak print. So you're going to see this volatility in the market for the coming weeks and months.
Down 10 basis points at the front end, just below 290 at 289 on a 2-year. Jim Bianco, your thoughts, sir?
It's a recession. I mean, we could stand on our head and we can twist all we want, but there's never been an example of 2 negative quarters that wasn't a recession. And I agree with Subhadra. Getting rid of forward guidance, and count me as one, thank God they did, that this is going to make the bond market more volatile because now we're going to have extreme reactions to data. We got some weak economic data today, down go interest rates. We get some strong inflation data down the road, up go interest rates. So everybody get ready because this is going to be a very volatile environment.
Jim, as Subhadra pointed out, you could interpret this data as weak and therefore believe that the Fed's going to back away. Is that your assessment of things as we look at a 2-year yield plunge lower?
This is the question, you know, because if we want to look past the data, we've got 9% inflation. Maybe it's going to come down to the high 8s. We've got negative GDP. Which matters more? Now, in Wall Street, the weak GDP, the negative real growth data matters more. But I have a feeling at the Federal Reserve, it's going to be the high inflation data. Look, the Federal Reserve raised rates 75 basis points less than 24 hours before the second negative GDP report and told us they're going to continue to raise rates. They're sending a very loud and clear signal. Yeah, we may have weak data and you may hope we're going to stop because of this, but I have a feeling they're really not going to until they see serious signs that the inflation data is turned, and we don't have that just yet.
We've got a 9 handle on inflation. Subhadra, how much weakness in this economy do you think they're willing to tolerate?
You know, I'm not sure I necessarily agree with Jim's view. I think that I've always argued for a while now that it makes very little sense for the Fed to raise rates indiscriminately because of inflation, get the Fed funds rate to 4% or beyond, and then orchestrate. Then you get a hard landing, and then the next thing you know, they're going to have to cut rates aggressively as well to counter that slowdown in the economy. So I think a much more sensible approach would be for them to sort of assess the data, maybe get the Fed funds rate to around 3.25%, and then they wouldn't have to cut nearly as much as inflation remains high, and that's where the market is right now. We were pricing in for the 10-year Fed funds rate around 3.8% at the June meeting. That's moved on quite substantially to around 3.25%. But the market also, has a much more flatter path after the peak Fed funds rate, and that sort of trajectory to me still makes a lot of sense.
Subhadra, that sounded like the should-shouldn't debate. What they should do, what they shouldn't do. Is that the same as what you think they will do?
That's hard to know, of course, because it all depends on the data. I think at some point later on this year, they're going to have that debate about whether they care more about inflation or they care about the unemployment picture. You're starting to see claims rise gradually. Yes, the employment picture is still pretty robust, but with weakness in growth, if you look at the data, whether you look at manufacturing, look at housing, you look at pretty much the consumer sentiment, you're starting to see weakness across a broad swath of metrics. So the Fed's going to have to weigh its inflation mandate with its full employment mandate at some point. And that we think is going to happen later on this year.
Next week, the ISM, ton of economic data, Subhadra, coming up next week. Futures right now negative about 0.1%, bouncing all over the place in the last 30, 40 minutes or so. Yields lower now by 11 basis points at the front end on a 2-year, 289. Mike McKee has spent the whole week telling us what is and what is not a recession. Mike McKee, what do you make of this economic data this morning?
It's not a recession, but it sure doesn't feel good, is the way I would put it. The folks down in Washington are going to be arguing over this for quite some time. If you are east of 20th Street, in other words, you don't work at the Fed, you're just going to look at that headline number, down 0.9%. But the Fed's going to take it apart. And here's what they're going to see. Consumer spending, not good, up 1%. That's hanging in there, but not really great. But the thing about the consumer spending was we saw a big shift to services from goods. That's been expected. And so if that continues, it's going to change the dynamic of inflation. Business investment down 0.1%, most of that in structures. Now, the other thing that is investment that really went down is residential housing, down 14%. So you can see the Fed's interest rate increases may be having an effect there. Here's the number, though, that third one there, inventories, that made the big difference. And this is all pandemic related. We had a big drop in inventories as companies sold out of everything during the pandemic. Then they ordered a bunch of stuff. It came in, but very slowly to the United States. And then all of a sudden, it was there, built up big inventories, and now they haven't been growing as much. That took 2% off of GDP. Exports, better performance than expected, 1.4% gain for GDP because of that. You mentioned inflation, John. You look at the nominal numbers, GDP was up 7.8%. And again, we lost 0.9 in the real numbers. So there is a major inflation impact in this data. And finally, your question, recessions. Well, Jim's right. We've never had 2 consecutive quarters that weren't a recession, but we've had recessions that don't have 2 negative quarters. And a lot of these recessions, the negative quarters didn't come till much later in the recession. So I'm not going to go with recession yet. The real question, though, is, of course, what does this mean for the Fed? Nothing at the moment, because they're going to take apart the numbers. They're going to look, and they've got a lot of data between now. A couple CPIs, PCE. We'll have 2 jobs reports before then, and putting it in a way you'd understand, John, trying to figure out today what the Fed is going to do on September 21st. September 18th, Chelsea at Liverpool. Tell me the score.
Yeah, I've got no idea. Yeah, and that's the problem, right? We've got CPI August 10th, we've got CPI September 13th, and we could be in a radically different place. Mike, this is going to be a battle about labels and what to call this, and I get all that. Here's another label. Can we call this stagflation now? Can we do that now, Mike?
Yes, you could call this stagflation now. I think the 2 quarters is enough to do that.
And that is a problem. And Jim Bianco, I want to come back to you. In that world, is bad news good news for this market?
Oh, I think so. And I think it has been that case. So if you go to a week from tomorrow when we get the payroll report, we get another strong payroll report plus 300,000 like the last one. That will be perceived as good news in the payroll front. Is going to be bad news for the markets because it will make the Fed go harder. If we were to get a weak number, that would be perceived as good news, kind of like what you see today, that the reaction is to a weak GDP report was to reduce the probability of a 75 basis point hike in September, and immediately the futures markets bounced.
And look at the reaction in the bond market. We're down 16 basis points at the front end today. In Germany, Subhadra, on a day we just had a really hot inflation print. Subhadra, what do you make of how the bond market is responding to the incoming information, both on output, economic data, GDP and the like, labour market data, and inflation, headline CPI, wages, etc.? I don't think I can connect with Subhadra. So, Jim, I can always just ask you the same question. Jim, why is the two-year yield in Germany down 15 basis points on a morning we've just had red-hot CPI out of Germany?
Yeah, I think it's reacting to the latest data, and the latest data is the weak growth in the U.S. And you're seeing, because it's moving in kind with what you're seeing in the United States, too, that you've got a big move down in yields on our yield curve as well. And in fact, you're actually seeing a little bit of a steepening of the yield curve. It's still negative, but it's just a little less negative. So the market is reacting to this data, and it gets back to the earlier question you asked us. And that is, we've got high inflation and we've got negative growth. That is stagflation. Which is going to matter more? I'll come back to what I said before. I think at the market level, we believe that real growth matters more. But I think at the central bank level or the Federal Reserve level, they're going to think that the inflation numbers matter more.
So, Jim, talk to me about how far they'll take this. Let me read you this quote from Citi. Andrew Hollenhorst came out yesterday after the news conference and he said, "We read Chair Powell's press conference as more hawkish than the market's interpretation. We continue to expect core inflation to push the Fed to hike more aggressively than they or markets anticipate, with a 75 basis point hike in September, policy rates reaching 4% by year end." Does that resonate with you in any way, shape or form?
No, it totally resonates with me because that's very similar to what I think that the Fed is going to do as well. There's a belief in the marketplace that inflation is still not a thing, that it might be transitory, that it's what we call peak right now. The idea that the Fed has abandoned forward guidance is data dependent. There's a hope that over the next 2 or 3 months, the inflation data will clearly show a peak, both core and headline, and that will give the Fed room to back off on the rate hikes. If that happens, that's true. But I tend to be in the camp that the data is going to be the inflation data is going to be a little bit more sticky, especially the core data is going to be sticky. Look, the shelter numbers are going to almost guarantee that you're going to have very strong core inflation numbers. And that is going to keep the heat on the Fed to keep raising rates. And the wish of Wall Street that weak inflation data is just around the corner to get the Fed to back off might be dashed yet again.
Well, Wall Street's getting its wish right now. We're down 11 basis points on a 2-year in the United States, in the Treasury market, 288. Jim Bianco is going to stick with us. We're going to try and re-establish that connection with Subhadra as well. Let's talk about some single names. Big afternoon of earnings coming up. Here's Kelly Lyons.
Yeah, buckle up, John. But of course, we've already had a big week so far, including Meta, which reported after the bell yesterday. First ever quarter of revenue growth dropping into negative territory. And actually, its guidance and forecast disappointed as well. They're suffering from that slowdown in ad spending, and it's exacerbated by the competition from TikTok, as well as those Apple privacy rule changes that Facebook has been warning about for some time. So that stock is down 4.5%. You also have Qualcomm down on disappointing guidance. It, of course, is the biggest chip maker for smartphones in particular, and it is warning that a weakening economy is going to mean consumer spending on mobile devices goes down. That stock down 3%. You also have Baxter International down about 7.5%. It's a healthcare supply company, cut its full year forecast, citing supply chain challenges and inflationary pressures. All stories we have heard before. One more positive story out there, not related to earnings, basically anything in the clean energy space, getting a huge bid today after that deal inked between Joe Manchin and Chuck Schumer on clean energy spending. One of those stocks, Plug Power, up a whopping 17% before the opening bell, John.
Kelly, thank you. Coming up, the recession debate down in D.C.
We're not trying to have a recession, and we don't think we have to. I don't think the U.S. economy is in recession right now.
I can't guarantee you much in life, but if you go down to Congress this morning and ask a Republican if we're in recession, they'll say yes. If you ask a Democrat, they'll probably say no. We're going to cover that next.
We're not trying to have a recession, and we don't think we have to. I don't think the U.S. economy is in recession right now.
That was Chairman Powell yesterday. This morning, U.S. GDP contracting for a second straight quarter, setting the stage for a heated debate down in D.C. The administration moving quickly to address the latest data, with Secretary Yellen and President Biden both scheduled to speak later this afternoon. Down in Washington, Anne-Marie joins us now. AMH, you know how this is going to go through the next 24 hours, the next several weeks, the next several months.
Yeah. Yeah, Jonathan, I mean, the Democrats are going to come out and try to change this definition that many people are accustomed to in terms of a technical recession, 2 back-to-back quarters of negative growth. We've never had a recession before in the United States that we didn't see 2 back-to-back quarters of negative growth. And for many Republicans, they're going to say this is a technical recession. But regardless of the definition, everyone in Washington is going to throw at you, and many of them not economists. The fact of the matter is, and Mohamed El-Arian talking about that today, who's been flagging this for months, we are now in deepening stagflation, and there is recessionary risks. So whatever you want to call it, this administration needs to deal with the fact that there is a recessionary risk now in the U.S. economy about 100 days out from the midterm election.
Anne-Marie, it's unfortunate for the administration because just last night, yesterday evening, they got some good news. An agreement potentially with Senator Manchin. What does that agreement do to address some of this?
Well, it'll bring down the deficit, right? And this was the biggest sign from Senator Manchin, or the biggest provision he wanted to make sure that it would be included, that if you're going to pump money into the system, it cannot be inflationary. And that does seem to be, he's happy enough with that. And then you had Larry Summers today on CNN talking about the fact that this would not be inflationary. And it was a huge win, Jonathan, for the administration. They're getting some changes in tax provisions, energy, climate, Medicare provisions. The issue is it's not as big as what they came in and hoped for with the Build Back Better, but it is a win, and it was Senator Manchin who was able to deal that win for the president. So they got the CHIPS bill yesterday, they got this mini Build Back Better yesterday, but this morning they're waking up with some pretty concerning data.
AMH, thank you. Anne-Marie down in Washington. A little bit later, 2:15 Eastern Time, we'll hear from the President of the United States. We'll hear from the Treasury Secretary as well, Janet Yellen, on this topic. You can imagine how this is going to go. Subhadra Jaffer joins us on the phone now. Subhadra, I understand you've got some internet problems, and that's life, so we're going to do this on the phone just briefly. The chairman says we're at neutral on Fed funds. How does he know?
Well, no, I don't think he knows, and I don't think any of us know where neutral is exactly. We will know when he's, hiked well beyond neutral and you see a meaningful slowdown in the economy. But, honestly, it's going to be very, very hard for them to know exactly where neutral is. I mean, Bill Dudley in your show has, long argued that the neutral Fed funds rate is around 4%. But, those things change quite meaningfully. If you start seeing a meaningful slowdown in growth, it's going to be very tough for the Fed ultimately, regardless of where neutral is, for them to continue to raise rates indiscriminately because inflation remains high. So they're going to have to balance, if you will, their mandate between inflation and employment. And if it starts to show up in the labour market in a more pronounced way, then those two sides of that mandate are going to be in more obvious conflict. Subhadra, great to catch up with you as always. Subhadra Jaffer there. Jim Bianco. Jim, what do you make of this debate down in Washington?
This is not new. If you go back to the late 1970s, the prominent economist Alfred Kahn spoke in front of Congress. Back then, the Carter administration was trying to redefine a recession, and he referred to it as a banana. And we don't have a banana, or whether or not we have a banana. And it just feels like we've just gone right back to where we were nearly 50 years ago, and nothing has changed. It's always been political to decide whether or not there is a recession or whether or not there isn't. But what we do have is real growth slowing quite dramatically the second consecutive quarter. And we might not be done, because remember, the reason that we're having a hard time understanding this is that we have positive real growth. It's just not faster than the inflation rate. And if the inflation rate stays strong in the third quarter, we might have another negative quarter in the third quarter, and that will just further embolden this debate.
Jim, look at this move on the front end this morning. We're down 17 basis points on a 2-year to 282. 10 to down 12 to 266. Jim, there is this feeling. You and I speak to a lot of people. You hear them on this show. There's a feeling that people think we're going back to 2019 again. Low rates again, low growth, buy tech, all of that. Jim, are you pushing back against that as well?
Yes, I've been really pushing back hard about that argument. And what that means is that the pandemic meant nothing, in that people do believe that the economy is still fundamentally the same economy as it was pre-pandemic. And I've argued it really isn't. There's been a change in the economy. Now, don't mistake that for dystopian. It's different. And one of the things, if you want one example, is the enormous amount of work from home. It changes your lifestyle, my lifestyle. It changes the consumption basket. That's why we've got, I think, chronic supply chain problems, and we need to have a revamp of the entire system. Instead, we keep saying, just wait, inflation will go away, people will return back to the office, everything will go back to 2019. But until we're ready to have that conversation that this economy needs to be restructured, I think we're going to continue to stay with problems. And you see that with the markets today. This is a typical 2019 response in the markets.
Yeah.
Weak real data, interest rates plunge. What about inflation? Well, the inflation data we're hoping is going to match that in the future. Now, it very well may, but so far it hasn't.
Jim, this raises really big questions about the Fed funds rate. And even if it does peak sometime soon, how long it stays there if you believe inflation is going to persist for a whole lot longer?
Yeah, the thing to keep in mind about the funds rate, the Fed likes to say that neutral is positive real 0.5%. Now, what that means is the inflation or the interest rate is 0.5% above the inflation rate. Now, it doesn't have to go to 9.5 because inflation will probably come down some. But look at wages. Wages are growing at 5%. If we continue to have 5% wage growth, people can pay a 5% inflation rate. That would suggest that we could have a 5.5% funds rate. Now, will wages come down all the way to 2%?
Yep.
Well, that's going to be tough because the Atlanta Wage Tracker says that people that switch jobs are getting about a 6.5% raise, where people that stay at their job are getting about a 4% raise. So there is an incentive by employers to pay up for talent, and they're doing it, and they're going to continue to do it. So as long as we have strong wages, yeah, we won't have 9% inflation, but we might have 4 or 5. And if we have to get to positive real rates, there's a lot more we have to go with on the funds rate.
Jim Bianco this morning, straight out the gate, recession with the R word, front and center. Jim, good to catch up, buddy, as always. Coming up, the morning calls, and later, Sam Linton-Brown of BNP Paribas joining us around the opening bell, expecting a grain of the Fed's less hawkishness to lead risk assets higher. We'll get some more of that in just a moment. Futures up 0.1%. This is Bloomberg. Four minutes away from the opening bell. Apparently for now, bad news is good news. Just a little bit of good news. How long that sticks, I don't know. We're up 0.1% on the S&P. Let's get you some morning calls. Jefferies downgrading Best Buy to hold $71 price target, highlighting the retailer's underwhelming results and challenging macro environment. Stifel upgrading Kraft Heinz to a buy, seeing stronger pricing power with continuing international growth driving shares higher. Piper Sandler cutting its Meta price target down to 190, expecting FX headwinds and weaker ad spending to continue weighing on shares. Coming up next, Sam Linton-Brown says positioning and valuation suggest risk assets can continue driving higher. That conversation around the opening bell. More reaction to a second consecutive quarter of negative growth in America coming up. Two consecutive quarters of negative growth in America coming into the opening bell. Equity futures, they're positive on the S&P, up 0.2%. Apple and Amazon reporting after the closing bell a little bit later. That's the next stop, the next big stop for earnings. The Nasdaq down just 0.1% after the biggest one-day pop on the Nasdaq 100 going back to November 2020. So this is how we react to a downside surprise. Equities are up, yields look like this. Your 10-year yield driving lower alongside your 2-year yield. Your 10-year down 11 basis points, your 2-year down even more. Euro dollar negative 1/3%, 101.68. And the crude market looks a little something like this. Back it away from 100. Got close earlier, 98.97. We're positive about 1.76%. That's the cross-asset price action. 20 seconds in. Let's get you some movers. Here's Katie Greifeld.
Well, it's all about earnings this morning. Let's start with Harley-Davidson. It has my favorite ticker, HOG. It's absolutely soaring this morning. Second quarter profit and revenue beat estimates. Revenue for motorcycles rising, even though bike sales actually fell 28% in North America. Shareholders also cheering the CEO's turnaround plan. Ford also driving higher. It reported yesterday adjusted profit more than tripled to $3.7 billion. Sales rose even though car prices did as well. That's pricing power. Worth pointing out, though, that this is for its last earnings report before cutting thousands of jobs. Southwest Airlines, as you can see, not faring as well. Southwest, one of many airlines forced to delay and cancel flights that weighed on earnings, along with high labor costs. You can see that in the shares. They're down about 5%. And Best Buy, another pre-announcement of bad news, though you're not seeing it in shares this morning. Best Buy surprised with a cut of its profit and sales outlook, citing high inflation hitting demand. We heard pretty much the same thing from Walmart earlier this week, John.
Dare I say, maybe finally now it's priced. In fact, I won't say that at all, because every time we hear this, another time the stock gap's lower by 20%. Katie, thank you. We're about a minute and 30 seconds into this. We're positive a third of 1%. Utilities top of the pile, up by more than 2%. At the bottom of the pile, you see healthcare. That might change in a moment. Communication services down by more than 1 full percentage point. For GDP, it's another negative GDP print in America, reviving an old debate. Katie Lyons, is bad news good news?
That's the question. At least today, John, it appears that is definitely the case, because after 2 back-to-back quarters of negative GDP print, we have stocks continuing their rally from yesterday. We're up on the S&P, we're up on the Nasdaq, and you're seeing massive moves in the bond market as well, with the 10-year yield now down 12 basis points. We're at the lowest level since mid-April at 266, and the move is even bigger on the short end, down 16 basis points on the 2-year to 283. The question is this going to hold? Because if you look back at the moves we've seen over the last 2 Fed meetings, yes, we saw jumbo hikes and then jumbo rallies. It didn't hold the day after the May meeting or the June meeting. And historically, according to Bespoke, when the S&P rallies 1% or more on rate decision days, the next day's average has been a decline of 0.3%, with gains less than half of the time. And if you actually look at the following week and the time until the next Fed meeting, stocks are traditionally lower if we saw a 1% move or greater on the day of a Fed day. So we'll see if the pattern holds. Wherever higher now, right now, when it comes to equities, because of that bad news is good news story. Once again, that leadership coming more from growth instead of defensive. So the idea here yesterday being that maybe the Fed isn't going to have to move as aggressively, John.
Kelly Lyons, thank you. What a move we've seen in the equity market. Remember, the equity market on the Nasdaq bottomed the day after the Fed last met, the June meeting. This is what Katie's talking about in terms of these good days we've seen on Fed days. I can tell you that 2s and 10s, the 2-year yield, the 10-year yield, actually topped the day before the June meeting. We talked about that yesterday. So June 14th, the 10-year was 349.65. Right now, it's 265.61. Big turnaround. Yields lower. Similar story across the curve on a 2-year. Right now, 283.79. The high, June 14th, 345.19. Big drop lower. Jim Bianco said it earlier. This Fed's going to become very, very data dependent, and we're going to be very sensitive to that incoming economic data. Though given that we don't have a clear idea of how they'll respond to that data, that's just going to amplify the uncertainty and the magnitude of the move. And Mike McKee, that's what we see again today in this bond market.
Yeah, you're seeing the bond market react, and I tell you, the bets, Fed funds futures on the September meeting have just fallen off a cliff, because people are, at this point, suggesting we're going to be in recession and the Fed's going to have to back off. But as I've reminded you, we have a long way to go between now and September 21st. The GDP numbers were not good. We are, at this point, seeing that down 9/10, of course, much of that inventories. So that could reverse, and we'll be 3/4 of the way through the second quarter, or third quarter rather, when we get to the next Fed meeting. And we have these numbers coming up ahead of the Fed meeting. So you're going to have a lot of data that could change people's minds. Now, when Jay Powell was talking yesterday, he said we're going to try not to contribute to volatility. They're not going to have a whole lot of choice about that, unfortunately. The market's going to react as the market's going to react, because at this point, there's no more forward guidance. And so they don't know what the Fed is thinking. We'll obviously be paying a lot of attention to the Jackson Hole speech that Jay Powell will be giving at the end of August, and then all the Fed speak between now and then as people try to divine what's going on. Keep an eye on the Fed funds futures. They have obviously changed today, but they will change many times ahead, and we will see. You can see there the view of Wall Street is that the Fed is going to be much slower to raise rates, but we'll see if that changes. We get some strong numbers in those other data releases, particularly CPI. We could see that change.
The data ahead that you just put up for the next 2 months, there was one date that jumped out, and we talked about it in the last week. It's September 13th. CPI comes in a quiet period for the Fed. Is that going to make a difference, or do we have a new routine for this Fed now in a quiet period?
No, I don't think they'll do that again. I mean, it is really tough for them to do that and then retain credibility in what they're telling us going into the meetings if they want the markets to react correctly to what they're doing. But it is going to present a dilemma because it's in the quiet period. We're not going to know what they think about that number, and that's another reason for volatility ahead.
Got some volatility for sure right now in the bond market. Mike, thank you, buddy. As always, let's work through this bond market. Yields lower by 16 basis points on a 2-year, 284. On a 10-year, down 13, 266. Your equity market's doing OK, up a third of 1% on the S&P. And Sam Linton-Brown of BNP expects you could see a whole lot more of the same. The risk rally is realising. Peak hawkishness has provided the trigger. There is further scope for gains. Market technicals, positioning and valuation suggest risk assets can continue to gain. Sam joins us right now. Sam, good to catch up, sir, as always. Is bad news good news?
It is today. I think, look, our thesis here has been that the market is positioned very short risk, valuations are very depressed, and therefore that the bar for a trigger for a squeeze of that position into the summer is actually very low. And with the dovish Fed yesterday, where expectations had also built pre-meeting that we would begin to see some elements suggesting a less hawkish Fed going forward, that's provided that trigger for risk. And given that the market's still short, given that valuations are still depressed, we think positions can continue to squeeze into the summer.
Sam, when do we start to focus on why they'll be less hawkish, which is not because inflation's coming down, because we've just had a second consecutive quarter of negative growth in America. And in Europe, Goldman's calling recession this year. JP Morgan's calling recession this year. When do we start to focus on that?
It's the key point. And if we look back at what's happened since the June Fed, it's quite interesting because the first observation would be that inflation expectations in the US have actually gone down. The second observation would be that less tightening is now priced for the Fed. And those two observations combined suggest that the market prices a much weaker growth backdrop. The market's much more fearful of recession, of activity slowing down, as you're pointing out, and as the popular market narrative is. But if we then also look at the way risk assets have traded, there are stronger levels across both equities, credit, high beta versus low beta currencies, et cetera, than they were at the time of the June Fed. And so while, of course, to some degree, growth concerns are driving peak hawkishness, I think perhaps there's also something going on under the surface around the market's perception of inflation persistence. And we're seeing that in some of the PMI data, showing that supply constraints are beginning to ease. And to some extent, the market also might be questioning if the second round feed through from higher energy prices is going to be as strong at the moment, given that growth is, of course, slowing quite materially. So I don't think the driver of peak hawkishness in the market's mind is entirely recession fears. Of course, that's a key part of it. But I think it's also partly less conviction in the persistence of inflation. And if that latter factor continues to drive the market's direction, then I think it suggests the risk rally has plenty of legs.
Break-evens speak to that story too. So, Sam, if that's true, and other people disagree, but this is your position, so let's explore it. Where do you want to be in this equity market, and where do you want to avoid?
I think the key is the assets that are most aggressively positioned right now are those where we see scope for the biggest squeezes. So we'd sort of broaden the discussion beyond just the equity market. So in currencies, the market's very long dollars. We think that's a position that's going to be challenged over the next month. And it's long dollars against those currencies which typically go down most amid growth fears, such as the Australian dollar, such as the Norwegian krona, such as EM commodity exporters. We think those currencies will squeeze higher against a dollar that's weakening. In Europe, equity positioning, as we all know, is very bearish. And here we think that financials can recover. In the US, we like domestically orientated value, and that's a sector which we also think can outperform. Similarly, energy trades at multiples which we think are not justified in the current environment, and that's a sector in the US that we think can outperform.
Sam, that call you've got on banks, you know it's controversial. Can you tell me why the banks in Europe perform with an ECB hiking into a recession?
It's a question of how much is in the price. And I think the movement that we've seen in European yields, the popular market narrative about the growth backdrop in Europe I'd argue it's really heavily discounted already into current market prices. You see that across a number of metrics, but one that we like to look at is equity risk premium in Europe. It's currently at higher levels than it was during the peak of COVID. And it means that in order to rationalize current prices, if you assume a normalization of that risk premium, earnings need to fall by an amount that's not only compatible with a mild recession in Europe, which looks likely, it's effectively our base case, but one that's a deeper recession in Europe. So the way that we'd advocate positioning portfolios is where you hedge the downside tail in Europe. Clearly, the energy crisis presents a very serious downside tail that one needs to protect against, but in a way that skews the core portfolio positioned risk on.
How do you navigate the redenomination risk that might come about on the periphery in Europe, Sam? How is that a factor in all this?
Ultimately, we think that the TPI introduced by the ECB in the medium term will prove to be credible. That said, the construction of it, where the threshold for activation might be high, it's very much discretionary, and the ECB have introduced a tool that in some respects is a little bit more reactive than it is preventative at a time where idiosyncratic political risk in Italy is rather high. Suggests the market's going to test the ECB. So we expect spreads to widen. We think Bund BTPs will trade out to 260 bits. That said, in the medium term, we don't think the market's going to be able to reliably price redenomination risk or systemic risk in Europe. TPI is one part of that, but also all of the supranational mutually assured issuance that we have as a result of NGEU is another part of it.
So many acronyms when it comes to Europe. Sam, appreciate it, buddy. You're an optimistic guy, that's for sure. Sam Linton-Brown there on Europe and the world and why he thinks this rally can continue. It's stalling now a little bit. We're unchanged on the S&P. We're negative 0.2 on the Nasdaq. We've talked a lot about this bond market. I'll keep pouring over it for you. We back away from the lows of the session. On a 2-year, we're down 13 basis points. The 10-year is down 11. That's how we respond to a downside surprise on GDP and a second consecutive quarter of negative growth. We send yields a whole lot lower. Coming up, investors looking to Apple and Amazon results amid growing concerns about the US economy.
With the kind of concern over inflation and the economy, a lot of the focus is going to be on the outlook for next quarter. We're all looking for kind of tea leaves on what's the impact of economic weakness.
The conversation up next.
Perpetual headwinds. That's kind of even an understatement. It's shocking the turnabout that this company has experienced. For much of its history, it was the most profitable public company, period. And here it is, like struggling to find its way with an uncertain future direction, a seemingly seriously challenged current business, and strategic problems really right and left.
Big tech in focus in a big way over the last week. Facebook yesterday, a little bit later today, all about Apple and Amazon. Right now, it's all about a second consecutive negative quarter of growth in America. This from Ellen Zentner of Morgan Stanley. 2Q GDP, technical recession confirmed. She goes on to say real GDP contracted in the second quarter, making a technical recession. We expect stronger growth in 3Q 22. We've got a statement from the White House. I've just gone through it and I can tell you the R word does not make an appearance. For more, let's get down to DC and catch up with Anne-Marie. Hey, Anne-Marie.
Jonathan, they're going to do everything they can to avoid the R word. I mean, do you remember the Carter days when Alfred Kahn didn't want to use the R words? We started calling a recession a banana. We're almost at that point with this administration. This is what the president has to say this morning. Coming off of last year's historic economic growth and regaining all the private sector jobs lost during the pandemic crisis, it's no surprise the economy is slowing as the Federal Reserve acts to bring down inflation. The president is making it clear he wants the Fed to be independent, but they certainly want inflation to come down. That has been the top priority of Americans when you look across the polls. But in doing that, there's always been this risk that there would be a very, very narrow landing of potentially avoiding a recession. Right now, what we have today is showing that we have 2 quarters of back-to-back negative growth. Common rule of thumb, that is a, quote, technical recession. This administration is going to do a lot of work over the next 24, 48 hours to tell you it's not.
The political spin commences down in D.C. I have to say, It already started in the last week before we even got the number. Anne-Marie, great work as always. AMH going through some of this reaction. She'll do that all day for you on Bloomberg TV and on Bloomberg Radio. The economy's slowing. We can all agree on that. Mark Zuckerberg can too, over at Meta, Facebook. This is what he had to say. We seem to have entered an economic downturn that will have a broad impact on the digital advertising business. The situation seems worse than it did a quarter ago on the West Coast. Let's get to Ed Ludlow. Hey, Ed.
Yeah, good morning, John. Meta declines have accelerated beyond 8%. That puts the stock on track for its worst performance since February, which you'll remember was when they reported fourth quarter earnings, where growth stagnated. And so the drama of what we're seeing play out, you read the Wall Street reaction and there is a smorgasbord. This was the first ever quarterly decline on the top line for Meta. And you heard what David Kirkpatrick had to say about the company's history. But the street sees a smorgasbord of issues. The changes that Apple made to its iOS privacy tracking still continues to hurt this company. And what's so interesting for the Facebook parent is the impact of the stronger dollar also weighing on the company. You know, how often have we heard that in the last week alone from the likes of Microsoft and, of course, the likes of Alphabet also flagging that? On days like this, you look at those numbers, John, I like to go to MODL Go once we've had the earnings print. So the deviation between the top line of what they posted in consensus was marginal, 0.4%. But you go straight to ad revenue and it was much wider, 1.4%. It's simple. There is a pullback in the advertising industry due to the macro picture that Zuckerberg outlined, but they're also competing for smaller budgets. And it seems, based on the commentary of the earnings call, that names like TikTok are winning out against Meta and Facebook now really pivoting to Reels. The problem with Reels, and I don't know if you're a user of that product, is that it's yielding a much lower revenue per user or per ad than the rest of the Facebook platform historically has done. So a lot of problems here and no immediate sign that things are going to improve.
I'm happy to say that app is not on my phone. Ed, thank you, buddy, as always. Ed Ludlow on the West Coast. There's going to be a whole lot more a little bit later. Ed's going to be a busy man. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Yeah, $7 trillion worth of market cap is reporting today in the S&P 500. More than a third of that is just two companies, Apple and Amazon, a whopping 10% of the S&P 500. And both stocks are down today ahead of their results. What's interesting, though, is coming into today, Apple was actually up 15% in the month of July, heading for its biggest monthly gain in 2 years. So that raises the bar to a certain extent as the company faces challenges, including cooling consumer demand in the face of inflation, both demand and supply issues in China stemming from the COVID-0 policy, which is why starting tomorrow, some of those top-tier iPhones are going to go on sale in that market. And a stronger dollar, a headwind, too, as Ed was just mentioning. Put it all together, revenue is expected to be up 2%, earnings down 11%. For Amazon, earnings expected to fall 31% as they deal with higher costs on labor and freight, while revenue is expected to be in the single digits for the third quarter in a row. We're really looking for a read on the consumer as well as the job market from Amazon, because not only is it one of the biggest market-weighted companies out there, it's the second biggest employer in the United States. And we already heard from them that they overhired during the pandemic. They're looking to make adjustments. So any commentary around that will be closely watched. And I would bet by the White House, too, John, because taking a look at that statement they just put out on second quarter GDP, the president talking about a historically strong job market, consumer spending still growing. I wonder to what extent Amazon is going to be a tell on how much or how little that is still true.
Interesting. We got a hint from Walmart earlier this week, didn't we? Kelly Lyons, thank you. May 4th, the Nasdaq was up by 3.41%. That was a Fed meeting day. June 15th, it was up by 2.49%. That was a Fed meeting day. On May 5th, the day after the Fed meeting, we were down 5%. On June 16th, the day after the Fed meeting, we were down 4%. Today, the Nasdaq 100 is down 1% after being higher by 4% yesterday. You get the picture. It gets choppy, the 24 hours around the Fed. And I said yesterday, don't define a Fed meeting by some intraday price action. It's going to all be about the data. GDP this morning, then it's on to the ISMs next week. We get CPI on August 10th. Tomorrow, the employment cost index too. The ECI coming right up. I'll drive you through the trading diary, the events you need to be watching very shortly. That's next. This is Bloomberg. Is bad news good news? The answer to that seems to change every 10 minutes right now. Right now, it's bad news. We're down 0.6% on the S&P 500. On the Nasdaq, we're down by more than 1 full percentage point. For the bond market, seemingly it means fewer rate hikes. 2s, 10s and 30s. 2s down 12 basis points. 10s down 12 basis points. That's the price action. Here's your trading diary. After a second consecutive quarter of negative growth in America, Secretary Yellen's got things to say. 1:30 Eastern Time. The president has things to say as well. 2:15 Eastern Time. We'll get some earnings from Apple and Amazon after the close a little bit later. European bank earnings continue Friday with BNP Paribas and Standard Chartered. We round out the week with PCE and UMich Consumer Sentiment Survey on this side of the Atlantic and CPI on the other side. From New York City, this was the countdown to the open. Thank you for choosing Bloomberg TV. This is Bloomberg.